Whether you are a business owner looking to optimize your corporate tax strategy or a key partner trying to understand how to balance your personal wealth building with meaningful employee care, this episode will give you a clear, contradiction-free path forward through our S3 approach to qualified retirement plans. If you've been following our series, you know that we have been building a house together. First, we established a safe foundation, looking at how to protect and stabilize your primary retirement architecture. Then, we integrated simple profit-sharing flexibility, ensuring your business could adapt to changing economic seasons without unnecessary stress. Today, we arrive at what is often considered the ultimate planning challenge faced by high-income business owners. It is a moment where the financial industry traditionally presents you with a forced choice. Standard brokers and off-the-shelf financial narratives will tell you that you must choose between two opposing goals. Either you accelerate your own personal tax-deferred wealth through something called a defined benefit plan, or you manage your employee benefit costs affordably through a standard defined contribution plan, like a basic 401. At SafeSimpleSound, our framework rejects this forced choice entirely. Through the principle of both-and solutions, our team engineers sound optimized strategies. These strategies synthesize massive, legally compliant owner deductions with sustainable, meaningful employee benefits. We call this stakeholder synthesis. It is the idea that you do not have to sacrifice the financial security of your own family to be a good steward of your employees, nor do you have to neglect your team to build your own wealth. There is a path forward that honors both. So, find a comfortable spot, take a deep breath, and let's explore how steady, reliable wisdom can transform this apparent dilemma into one of your greatest financial advantages.
I want to pause here for a brief architect's note about the tools we have built to help you with these specific challenges. Most financial advice is just a collection of tips and tricks. It's like trying to run high-end software on buggy operating system. My job here at SafeSimpleSound is to help you upgrade that operating system so that you can close the gap between knowing what to do and actually doing it. If you ever felt like you know what you should do but you're not doing it, it's not a knowledge problem, it's a capability gap. I have released the first 9 chapters of my book, SafeSimpleSound, as a foundational guide to help you debug the system. Details on your screen now.
Let's begin by examining this common challenge more closely. If you are a high-income earner or a successful business owner, you have likely sat across the table from a traditional financial broker or a well-meaning accountant who handed you a cookie-cutter 401 proposal. When you ask them, "How can I put more away for my own retirement to offset these high taxes?" they likely pointed to the IRS non-discrimination testing rules. They probably told you that if you, the owner, want to aggressively favor your own wealth accumulation, it violates the testing requirements unless you also make prohibitively expensive contributions to all your employees. While it is absolutely true that IRS testing is strict, and rightly so, as it ensures fairness, the assumption that you must sacrifice your own wealth acceleration to care for your team is an either-or fallacy. This is where standard industry advice stops and where the SafeSimpleSound approach truly begins. From a SafeSimpleSound perspective, this provides the stability and innovation we look for. By utilizing advanced, contradiction-free plan designs, we can explicitly resolve this dilemma. Drawing from our team's CFC background at SafeSimpleSound, our approach suggests architecting a plan that legally and systematically targets the majority of the contribution dollars to the business owners and key partners, while simultaneously providing a highly valuable, compliant benefit to the rank-and-file employees. To understand how we achieve this both-and solution, we need to translate a few complex tax codes into conversational language. Don't worry, we are going to keep this incredibly simple. The IRS tax code provides 2 main avenues for retirement savings in a business. The first is governed by Section 415. This is the defined benefit limit. Think of a defined benefit plan like building a custom house where you know exactly what the finished product will look like. The IRS allows you to decide what your benefit or income will be at retirement age, and then lets you work backward, funding as much money as mathematically required today to build that house. Because older business owners have less time until retirement, The math allows for massive age-based funding. We are often talking about hundreds of thousands of dollars in tax-deductible contributions per year. The second avenue is governed by Section 415. This limits defined contribution plans, which are your standard 401s and profit-sharing plans. If a defined benefit plan is like building a guaranteed house, a defined contribution plan is like planting a garden. The IRS strictly limits how many seeds or dollars you can plant each year. Whatever grows, grows. The contribution is defined, but the end benefit is not. Navigating these two distinct tax codes requires what we call confidence. It requires a deep actuarial understanding to transparently explain the strict testing involved. Standard brokers shy away from this because it is a highly technical space, but through our S3 framework development, we rely on time-tested IRS codes applied in modern, innovative ways. This ensures your strategy is legally sound and profoundly effective. So, how do we bridge the gap between the massive deduction potential of a defined benefit plan and the predictable, understandable nature of a defined contribution plan? We use the ultimate both-and solution, the cash balance plan. A cash balance plan is a hybrid. Legally, under the tax code, it operates as a defined benefit plan. This is what unlocks those massive six-figure annual tax deductions for older owners. But to the employee, it looks, feels, and acts simple like a defined contribution plan. They don't see complex actuarial math, they just see a clear account balance that grows every year with employer contributions and a guaranteed interest credit. This perfectly aligns with the principle of stakeholder synthesis. When we pair a cash balance plan with a safe harbor 401 and a profit-sharing plan, a business owner can potentially double or triple their tax-deferred savings soundly and legally. You are bridging the gap between high-end, aggressive tax strategy and genuine, understandable employee care. It is a beautiful demonstration of how systematic thinking creates harmony where there used to be friction. Now that we have established the foundational mechanics of these plans, let's look at how they operate in the real world. To illustrate this principle, let me share a hypothetical scenario that demonstrates how a both-and hybrid plan works in practice. Consider this hypothetical situation. Picture a fictional company called Apex Engineering, owned by two partners, David and Sarah. David and Sarah are both 55 years old. Over the last 2 decades, they have built a highly successful firm, generating significant revenue. However, because they reinvested everything back into the business during their 30s and 40s, they are now feeling a very common, very understandable anxiety about their personal retirement readiness. Apex Engineering has 15 employees. Most of these team members are incredibly talented junior engineers and administrative staff in their late 20s and early 30s. Currently, David and Sarah have a standard, off-the-shelf 401 plan. They are maxing out their personal contributions, but they are incredibly frustrated. Between federal and state taxes, they feel like they are losing almost half of their hard-earned top-line revenue. They want to shelter an additional $150,000 to $200,000 each per year. When they asked their previous traditional broker about this, they were told it was impossible without giving away a fortune. The broker said, to put away $200,000 for yourselves, non-discrimination testing requires you to give your 15 employees a massive percentage of their salary, which will cost the company well over $150,000 a year. It's an either-or choice. You either pay the IRS in taxes or you pay your employees in benefits. In this hypothetical story, David and Sarah feel stuck. They want to be generous to their team. They value them deeply, but paying $150,000 in extra employee costs entirely defeats the purpose of the tax savings. Then David and Sarah apply the SafeSimpleSound framework. Through our team's methodology, we introduce them to the secret engine behind these hybrid plans. It is a concept called cross-testing, which is also known as new comparability. Let's make this simple. Traditional non-discrimination testing looks at the percentage of pay going into the retirement account today. If David gets a contribution equal to 10% of his salary, the standard testing says the 25-year-old junior engineer must also get roughly 10% of their salary. But cross-testing changes the lens. Rather than testing contributions based purely on what is going in today, the IRS allows us to test based on the projected benefit at retirement age, which is typically age 65. Think of it like an investment race. The 25-year-old junior engineer has 40 years for their money to compound and grow before they reach age 65. David, at age 55, only has 10 years. Because the 25-year-old has the massive advantage of time, a small contribution made for them today will grow into a large benefit at retirement. Conversely, to reach the exact same proportional benefit at age 65, David must legally put in a drastically larger sum of money today because he has no time left for compound interest to do the heavy lifting. By using cross-testing, we use Apex Engineering's unique demographic profile, older owners and a generally younger employee base, as a strategic advantage. In our hypothetical scenario, we architect a combined safe harbor 401, profit sharing, and cash balance plan for Apex. The result? David and Sarah are mathematically permitted to contribute over $200,000 each into their own tax-deferred accounts. And what about the employees? Through the precision of cross-testing, the required contribution to satisfy the IRS non-discrimination rules for the 15 younger employees drops from the unaffordable $150,000 down to a highly manageable, sustainable $35,000 total. The employees are thrilled because they are receiving a guaranteed, employer-funded retirement contribution that feels safe and simple to understand. David and Sarah are relieved because they have legally sheltered $400,000 of their income from taxes, dramatically accelerating their wealth while only spending $35,000 in employee benefit costs. While this story is fictional, it demonstrates how our framework resolves the false either-or dilemma. It provides a highly effective both-and solution. This example shows patterns we observe constantly when families and business owners apply S3 thinking to retirement planning. The tax code is not just a list of restrictions. When understood with deep CFC actuarial insight, it is a roadmap for stakeholder synthesis. Whether you're facing this exact situation with older owners and younger employees, or something similar in your own practice, you can see how thinking applies. You do not have to settle for the cookie-cutter advice that limits your potential. You can design a financial architecture that cares for your people and forcefully protects your family's future. As we draw today's episode to a close, let's summarize the key insights we've explored from our series. We recognize that the industry constantly presents high-income earners with a painful contradiction: choose your own wealth or choose affordable employee benefits. We rejected that forced choice. By integrating the principle of both-and solutions, we showed how you can bridge the gap between IRS Section 415 defined benefit limits and Section 415 defined contribution limits. We discussed how the cash balance plan acts as the perfect hybrid, offering the massive tax deductions of a defined benefit plan with the simple, easy-to-understand account balances of a defined contribution plan. And perhaps most importantly, we explored the demographic strategy of cross-testing. By evaluating your company's unique age and income profile, we can optimize your plan, turning your specific demographics into a powerful strategic advantage. This aligns perfectly with the SafeSimpleSound ethos, providing stability, translating complex tax codes into clear paths forward, and ensuring every financial decision is built on a sound, legally tested foundation. This episode draws directly from our recent blog post, The Sound Strategy, Resolving the Defined Benefit versus Defined Contribution Dilemma, which you can find at SafeSimpleSound.com. There you can read the complete written framework at your own pace. At SafeSimpleSound, our guiding philosophy is educational generosity. We believe in providing complete actionable value, whether you ever become a client or not. Because these hybrid and cross-tested strategies require absolute actuarial precision, through our S3 approach development, we've created two incredibly powerful resources for you. First is the Advanced Hybrid Plan Optimization Playbook. This resource breaks down the exact math of these strategies in simple, visually engaging ways. It shows you exactly how defined benefit and defined contribution plans synthesize. Second is the Plan Readiness and Demographic Assessment. This is an actionable tool where you can audit your own company's age and income profile. It acts as a demographic analyzer to help you explore if a both hybrid plan could optimize your firm's specific situation. If today's S3 insights resonate with your family's or your business's situation, we invite you to explore what financial planning could look like through our SafeSimpleSound practice. Contact us to access both the playbook and the assessment directly on our website. Either way, you're now equipped with the capability to understand non-discrimination testing, cross-comparability, and the power of hybrid plan design. You now know what questions to ask your current CPA or broker. This is knowledge that will serve you, protect your wealth, and empower your business, whether you engage with our practice or not. Thank you for spending your time with us today. Remember, you don't have to choose between your family's financial security and being a generous employer. With steady, systematic thinking, you can achieve both. Until next time, stay safe, keep it simple, and ensure every financial decision you make is completely sound.
We have covered the theory. Now, a quick word on the resources available to help you with actual implementation. If you are realizing that your financial system has grown too complex to manage alone, instead of looking for additional products, look for diagnosis. Most people try to perform surgery on their finances even before they understand the pathology of their problems. I invite you to Clarity Diagnostic. This is a 30-minute pressure-free session where we look under the hood of your finances to look for any integration errors that are causing you anxiety. No sales pitch, just professional diagnosis of current state and a clear path forward. Book your session. Details on the screen now.